Hi, welcome to our webinar series. This webinar series is East Malaysia CPO webinar. Now, this webinar series is brought to you by Bursa Malaysia Derivative and managed by our company Excellent. Our topic for today is spread trading strategies using FCPO and FEPO. Our session for today, we are going to divide into two different sessions. The first 60 minutes will be presented by both our speaker, Mr. Calvin Chin and Susan Lau. And the remaining 30 minutes, we are going to open for Q&A and also our quiz session. Now, my name is Ting Ting. I'm your moderator for this session. Now, before I start, can you please make sure that you can see my slides? You can hear my voice. If you can see my slides, you can hear my voice. Can you please type in the chat box yes? Or there's the emoticon at the bottom of your screen. Just give a thumbs up or anything that you like in the emoticon. Very good. So I need to make sure that y'all can see me. You can hear my sound. Okay, well done. Now, please make sure that you can see everything. Okay, I think you're good to go. Now, if you can't hear us, nothing much that we can do for you, so you just need to follow the screen itself. Now, as you know, Malaysia internet is very weak. So to have a better quality of this particular session, please make sure that you turn off your video. So I repeat, please make sure that you turn off your video. Now, along the way, if you have any question, what you need to do is please click on the Q&A box. Can you see here? Just beside the chat box, there's a Q&A box, and you just type in your question and please send it to all co-hosts. Now, repeat, first, please do not send in the chat box because we might not able to pick up your question. As you know, chat box, there will be a lot of messages. And so please make sure that if you have any question along the way, you can type in the Q&A box. At the end of the session, we'll try to pick up all the questions and we are going to answer your question. So along the way, if you have any question, just type in the Q&A box and please send it to all co-hosts. If not, we are not able to receive your question. Now, just for information, beside today's session, upcoming for this particular month itself, we have two additional sessions. Next Monday, 22nd of November, we are going to have this topic called Trade to Win in FCPO and FEPO. Then we are going to follow by next Wednesday, how to diversify your portfolio with commodity futures. So if you are interested to register, you can scan this QR code or else you go to excellent.com, then you click on the events. You can search for the webinar session and you can register accordingly. Now, just for information, I'm not quite sure whether you're aware or not. For today's session, very unique, we are going to have a lucky draw session. We are going to give out 6 prizes, in total 6 prizes. So the first one, we are going to give out 5 prizes for this Touch and Go e-wallet reload pin, each worth Ringgit Malaysia 100. This is sponsored by Bursa Malaysia Derivative. And the second prize, we are going to give away 1 prize for this book written by our speaker for today, Mr. Calvin Chin. His book is Profiting from Any Market. So what you need to do to stand a chance to win this lucky draw, you just need to stay with us until the end of the session. Later, we are going to let you know what you can do to stand a chance to win this lucky draw. Now, just focus when the speaker presents. Now, before I start, the start of the day, we are going to introduce our first speaker for the day, Miss Susan Lau. She's the representative from Bursa Malaysia, and she's currently attached with the Commodity Derivative Products Development Team at BMD. She's responsible for improving and expanding the commodity product offerings of the exchange. So without further ado, I'm going to pass it over to you, Susan.
Okay. Thank you everyone for attending this session. Bursa Malaysia Derivatives proudly present to you the East Malaysia Crude Palm Oil Futures Contract, FEPO. Start with a bit of background. Bursa Malaysia Derivative, BMD is a subsidiary of Bursa Malaysia. We offer derivative products which are futures and options contracts. Our most successful product, the crude palm oil futures, is the global benchmark for the pricing of crude palm oil. Here's a snapshot of our product offerings. Our products are categorized as commodities and financial products, but the most popular ones are the FCPO and FKLA contracts. Today, let us introduce our new addition, the East Malaysia CPO, FEPO, as our new agriculture product. The FEPO, similar to the FCPO, has a crude palm oil as its underlying asset. It is just that the pricing of FCPO follows the CPO pricing in Peninsular Malaysia, while the FEPO follows the pricing of CPO in the East Malaysia, which is at Sabah and Sarawak. At the top left-hand side here, we can see the comparison for CPO production from Sabah and Sarawak and the Peninsular Malaysia. In the year 1995, Sabah and Sarawak together only produced 22% of the country's total production of CPO, while the Peninsula contributes 78%. 25 years later, in 2020, the ratio is already at 45% to 55%. So East Malaysia's contribution, 22% to 45%, we can see that the contribution of East Malaysia has becoming increasingly important. On the top right-hand side of the slide, the blue bar there represents the export volume of palm-related products from East Malaysia, while the red bar represents that of Peninsula. As of 2013, the export volume of palm-related products from East Malaysia has surpassed that of Peninsula. At the bottom part of the slide, the graph here shows the spread of physical CPO prices from Peninsula and East Malaysia. On average, East Malaysia price is at a discount of the Peninsula price by 46.40 ringgit. Okay, so zoom in to the palm planting landscape, we can see that both Sabah and Sarawak have around 1.5 million hectares of land planted with palm trees. However, the production from Sabah is slightly more than Sarawak. Let's look at some key differences between the FEPO and FCPO. So FEPO starts earlier at 9 a.m. You can see trading FEPO earlier than FCPO. Next, on ports of delivery, FEPO is the East Malaysia CPO, so its delivery points are at Lahad Datu, Sandakan, and Bintulu, whereas the FCPO's delivery points are at Klang, Pasir Gudang, and Butterworth. If you're wondering why the delivery point matters, they are the points for buyer and seller to take delivery of crude palm oil. But worry not, if you do not intend to take delivery, just close the futures contract before expiry of the contract, and you will not end up bringing CPO back home. So last is on the position limit. It is the maximum number of net positions you can hold at any point of time. We can see that the position limit for FCPO is double the FEPO. One of the reasons being FEPO is a new contract in the market. Okay, moving forward, let's look at FEPO's performance since its launch at 4th October. The blue line is the volume, and the orange line is the open interest. We can see that the FEPO is gaining traction. Incentive for trading FEPO. The 3-for-1 waiver program is ongoing. This means for every 3 lots FEPO you trade, you can get 1 fee waiver for 1 lot FCPO. Furthermore, if you trade FCPO, FEPO spread, that means if you hold 1 long FCPO and 1 short FEPO, or vice versa, at the same time, you can get 70% margin credit. A lot of people might wonder how this works. Currently, the margin for FEPO is 5,000 ringgit and the margin for FCPO is 7,000 ringgit. So you get 70% margin credit by trading the spreads. So that means when you have this pair of spread, you only need 30% of 5,000 plus 7,000, which is equal to 3,600 ringgit. So if you are new to futures trading, or if you wish to test out your strategies, we proudly present to you the Derivatives Trading Simulator. This is a platform where you can learn about the trading platform and test out your strategies with the real-time prices and charting tools. Just the funds and trading is simulated. To find the Derivative Trading Simulator, you may visit our website here or scan the QR code on this slide. You may screenshot this page too. So if you are not directed to directly to the simulator page, if you log into the Bursa Marketplace, you may also find the trading simulator at the Tools tab as shown on the screen. So after you access the page, just follow the steps and register for an account. So you can get free subscription on the Derivative Trading Simulator for 30 days. And if you encounter any issues when subscribing, please email us at futures.bursamalaysia.com. So that's all from me. Thank you. Back to you, Ting Ting.
He's the founder of Calvin Grayson Assets and Berhad, a prop trading firm specialized in trading BMD products. He's also the author of Profiting from Any Market. So please pay attention. Later, he's going to give out one of his book as a gift, as a lucky draw gift. So this is a technical analysis book. He's also the founder of Art Peak and Kebaya Trader Investment Interest Group. Now, he has more than 15 years in IT industry and palm oil plantation nursery industry. So, Mr. Calvin, are you ready?
Good evening, everyone. Can you guys see my slide?
Yes, you're good to go.
Okay. So, thank you, Pusa, for giving me this opportunity to share my knowledge, and as well as the very pretty organizer, and every one of you who's take your time to join my talk today. Thank you very much. Okay. So, without further ado, we go into our talk. Okay. Before we start, so we should we have a disclaimer. This talk is mainly is for education purpose, and there is no buy or sell call. You are advised to talk to your financial advisor or maybe any licensed investment consultant for any investment advice. Okay. Okay. So today we are going to talk about what you first we will talk about what you will get from this talk. Okay. Then later on who I am, and then Ting Ting already do a very good introduction. So maybe I will skip this one. Okay. What is spread trading? How spread trading makes money? Why I trade spread? And then FCPO and FEPO. So in this section, I might skip some of the slide because Susan has touched on the major point already. So, and then the next one, it will be what is inter commodity spread, how CPO and FEPO inter commodity spread makes money, and then after that, then I will pass it back to Ting Ting for Q&A. Okay. 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 So we are going to learn on Windows. Okay, we are going to learn at the calendar spread. today and the intercommodity spread. For this talk, we assume some level of experience trading with future contracts, future FCPO or FCPO or FEPO or maybe the FKLI. But beginners should benefit from this talk as well. So you are encouraged to ask questions. Okay, I will fine tune the talk along. Okay, the more you ask, then the more I will share, basically. Okay. This basically me, but I'm not going to go into this one, so you can take a snapshot. Tintin already make introductions. Okay, as mentioned just now, Tintin said we have a free gift of I think it's 5 free gift, right? So it's five set of touch and go, and then is one is my book. So you guys want to have tips on the questions or not? Okay, you just pay attention to my talk. Those points that I mentioned a few times, so normally it's the key point. Okay. Okay. What is spread? Okay, this picture actually can tell what is spread. So I think normally people will do buy and sell. Normally you do buy and sell. This is what we call outright. One buy, and then after that, one sell. Okay, go the ground doing business. But when you look at up there, you have a messy cable. This you can see that the cable actually connecting to the houses, supplying electricity and collecting consistent income. Okay, so spread is like the cable, and then you can we can get quite a relatively more consistent return as compared to the outright. Okay. Okay. Hold on. I think the one slide is there. Let me see. What is spread trading? Spread basically when you buy and sell two contract at the same time, or any given time at the end, the result is buy and sell. It's called spread. So today we are going to talk about calendar spread in the first sessions, and then after that we are going to talk about the intercommodity spread. So in this calendar spread, I'm going to use FCPO as an example. Okay, and later on in the intercommodity spread, we are going to use the FCPO and FEPO. Okay, so example, when you buy a February contract and sell a March contract, and this is called a buy spread. So it's a buy calendar spread. Okay, so in reverse, if I sell a February contract and then I buy a March contract, then this will be a sell calendar spread. Okay. Okay. So basically, in spread trading, we are trading the change of the net difference between the two contracts. Okay, I will give you an example. Okay, let me see whether you guys the slide correct. Yeah, not okay. Good. Okay, so on the right side, you can see this chart is the FCPO February contract chart, and then in the bottom here, the bottom, okay, at the bottom here, this bottom left side is the March contract. These two, we call it outright contract. Outright contract. Then on the right side, we have the spread chart. It's a FCPO February to March spread chart. Okay. So, but by looking at it, you might feel that it's just a chart. Okay, it's just a chart. Okay, but you look at the numbers. Okay. Hold on. Okay. So spread is basically the front month minus the later month. Okay, equal to the spread. Okay, I go very slow. Okay, so in this example is February minus March equal to February March spread. Okay, this is how we derive the spread. And in this example, the February is at 4881. The March is at 4755. When we minus out, the spread is 126. So this is how we derive the spread. But each of these contract is a contract by its own. This is a theoretical price that they should align with. But there are times that it will run a bit. Like for example, so maybe it's right now the February is 4882. Okay, 4882. Then the March is 4755. So when we minus out, it will be 127. But maybe the spread is still 126. Then we have an arbitrage opportunity. But today I'm not going to talk about arbitrage. The front month minus later month, then you will get the spread, the calendar spread. Okay. Okay. In here, we have different condition of the spread movement. Okay. So this one is leg, we call it leg 1. Okay. This is leg 2. Okay. In our example, this will be the February contract. This will be the March contract. Okay. So when we trade spread, we are trading the expansion and the net change expansion and the narrowing. Okay, for example, this one is up and down. So in here is expansion. From here to here is an expansion. Okay, then from here to here is a contraction because here is lesser compared to the middle line. Okay, so this makes the spread up and down. Okay, so there are times that maybe one of the leg is stay constant and the other one is moving. So if they move in this way, that means from here to here is an expansion. So expansion means the spread will go up. Narrowing means the spread will go down. Okay, and then of course there are certain times that they are synchronized, both going down. In here, the length is will be the same. So the spread will stay stationary, will not move. Okay. So then this the next example is the same but it's the reverse. Okay. That means from the widening to the narrowing, that means your spread will minus will go down. Okay. when your spread both go in the same direction, your spread will stay equal. This one also. This one is both going down, and this one also going down. So when you want the spread to go up, is when from narrowing to widening. Okay, if you want to if you see the spread going down, is from widening to narrowing. Okay, so this is a bit different from the outright trading. The outright trading is if the price go up, if the price is go up. If the price go down, its price go down. But this one, we use two contracts. The first contract is this one, and then the second contract. We trade the net difference, the net change of the net difference. Okay, understand? Okay, so in here, my drawing is a sideways drawing. Okay, in spread they also tend to trending. So spread might trend going up, and exhibit the same expansion and narrowing characteristic as well. Okay. Then we link the concept to the chart. Okay, this is how we see it. Okay. Okay. When this one going up, because this one from narrowing to widening, so that's why the spread go up. This is a spread chart. That's why the spread go up. When the spread, when one of the leg come down, but the other one it stays stationary, it become narrowing. So you see the spread come down. Okay. Okay. So this one repeat. If this one stays, the leg one stays stationary, and then the leg two come down, because it's from narrowing to expanding, it's go up. Okay, it's not going down because not we sometimes we have an illusion that by leg two going down it should go down. No, it because we track the changes of the difference, so it's expanding. Okay, so when the leg two go up but the leg one is stationary, then it's from expanding to narrowing. Okay, so that's why it come down. Okay, then spread not necessarily work in sideways. The spread trend to trending as well. Okay, in this example, the spread trending up. Okay, it still do the narrowing, expanding, narrowing, expanding, narrowing, expanding. So that's why it's like this, like this, like this, like this, like this. Okay, you see the relationship. Okay, so by trading spread, must be careful. When it start to trend, you have to change your strategies. Cannot use the mean reversion, purely mean reversion. Okay. Okay. What is mean reversion? Mean reversion basically is the price basically move around a mean line, the middle line, mean line. So mean reversion strategy is sell buy at the bottom part, then you will get profit. You'll get profit here. Profit. Okay. So this is a mean reversion strategy, and we use a lot in trading spread. Okay, so this chart, this finish, this slide finish. Same thing, this spread can go downhill as well, can go downtrend as well. Okay, meaning the spread is like outright, it can go sideways, it can go uptrend, and it can go downtrend as well. But along the way, they will do the expansion and narrowing. Okay. Okay. So this is the concept. The concept. Okay. So we go into zoom down into the different condition and the numbers. Okay. First, we look at spread going up. Okay. Spread going up basically is from narrowing. This one is narrowing to widening. Narrowing to widening. Okay. So how many conditions it will widen? First is just now is in our example is one of the legs stays stationary and the other one is going up, or one of the leg is stationary and the other way going down. Okay. The next example is two legs move in the opposite direction. So this will expand the spread as well. Next one is both moving up, but one of the leg is moved faster than the other one. Then we also have expansion. Either it move up or move down. One leg is faster than the other way. No, the front leg is faster than the other way. Okay, for this one is the front leg. This one is the leg two. Leg two. Okay, so we go into the numbers. Then you might able to see more clearly. Okay, so look at this one. Just now the example. 4881 is leg one. Leg one. This is leg two. Okay, this is the spread. Okay. So leg one is 4881 and leg two is 4755. So the spread, theoretical spread, it will be 126. Okay. Then maybe after a while, the leg one move to the 4900. But the leg two stays stationary. And right now you can see the spread increase, become 145 and increase 19. So this is expansion. Expansion. Okay. Next one. Okay. We use the same example. 4881, 4755, and 126 as the spread. And this time is let me see. Okay. Move in opposite direction. So that means this one go up, this one go down. Okay, this one go down, how many points? 15 points. This one go up, how many points? 19 points. Okay, so at the end, you get the expansion, and it's the spread increased 36 points. Okay, so when the spread increased 36 points, meaning that one contract you times 25, 36, 34 times 25. One contract you can get 850. Okay. The point, the value of the point is same as doing the outright FCPO. Okay. The only difference is the outright you need to pay one in, one out commission. Okay. And the spread you need to pay two in, two out commission. Okay. So that's the difference. Okay. Next one is the upper leg, the first leg is stay stationary, and the second leg is dropping. Okay, so in this case also is another case, it is the spread expanding. Okay, so in this case it expands 25 points. The next one is the front leg, the leg one is going up faster than the next the second leg. Okay, so in this case 4881 go up to 4950. Okay, 4881 950. Okay, so 69 points go up, and this one is 4755 minus 4790. Okay, so basically it go up 35 points. Okay, so the net is you get expansion of 34 points. Okay, so both is going up, but the front leg move faster than the later. Also, you will get expansion. The next one is go down, and the second leg is go down faster than the front leg. That means the first leg. Okay, so this also you get expansion. Okay. Okay, sorry. Okay. So next, we look at the narrowing, the contraction. So when the spread contract, narrowing, in here I point out 5 conditions for you. One is the first leg go down, but the second leg stays stationary. The second one is the front leg stays stationary. The second leg go up. So you will get a narrowing. This one also narrowing. Okay. Then or both leg is attracting to each other. That means it's going to each other. That means you're pointing to each other, moving in the opposite direction. But it's coming together. Okay, coming together. The direction is coming together. Okay, this one the spread will also be narrowing. Then the next one is the front leg move faster, going down faster than the second leg. So this one also it will be narrowing as well. The next one is going up, but the leg 2 go faster. This will also cause the spread to narrow. Okay. Go to the numbers. Okay. Example 4881 4755 and 126 example. Okay, this is our base example. So in the case that the front leg drop, the second leg stays stationary, then there is a contraction from 126 to 95. So it's a minus. Okay. Then the next one is attracting to each other, is narrowing as well. So this one drop, this one go up. So from 126 to 60, and it's narrowing. The net difference is narrowing 66 points. Okay. So in this case, if you do a short of the spread, then you will earn money. Okay. If you do a long spread, when long spread you're expecting it to expand, but in fact it is contracting, then you will lose make a loss. Okay. Okay. Next one is next example is the first leg stay stationary. Then the second leg is going up. Then this one will narrow as well, narrowing. Okay, so narrow 35 points. And the next case is going down, but this one going down faster than the second leg. The first leg going faster than the second leg. So in this case, you will also get a contraction. That means narrowing. Okay. The last case in my slide is the front leg. The first leg go up, but the second leg go up faster. This one also give you a narrowing condition. Okay. Then okay. Their case the spread will not move. Okay. So in here I point out 3 cases. First is both outright not moving. The first leg and the second leg is not moving. This one is very rare, very rare. Okay, not moving. That means the market nobody trade already. Okay, so the second one is both go down at the same rate, go down at the same rate, or it go up at the same rate. This do happen. This do happen very often. So we have to take note of this. Then sometimes people say, okay, why the outright go up but the spread is not moving? Okay, this could be the reason. Okay, so it's like here. In this, it go up here is equal. From here go down here is also equal. So spread is not moving, even though the outright is moving. Okay, so you have to recognize this condition. Okay, so the same thing lah. So same example. You will get a zero spread movement. Okay. So enough of theory already, enough of numbers. Actually, why we trade spread? Okay, is it because it's more complicated because you take one more leg? Outright is more direct, more easier. You don't need to calculate the difference. Okay, so why do we want to trade using spread? Okay, I give you an example. Many times we can analyze a chart and we get the trend right. It's going up. Okay, let's say for example. But most of the time you will get checked out. That means the uptrend is not move in a straight line one. There is a volatility go up and down along the way to go up to the target price. If the volatility is too high, it trigger your stop loss or your trailing stop. Then you are out of the game already. Or maybe when you enter, suddenly there is a high volatility coming in. It hit your stop loss. You also get out. Okay. So a lot of cases, the volatility will kill your setup. Okay. So we can use spread to reduce the volatility. So this is the rough statistic because the market is dynamic, it's moving. It's the market participants changing every day, or maybe their demand and the supply is changing every day. So that's why the volatility is different every day. Okay, but this is a general. At this moment, I think this number is correct. Okay, so you can see if you trade outright, the daily volatility is 130 points approximately. Okay, But if you look at the spread, we only 5 to 10 points, or maybe sometimes it go to 13 points. Okay. Okay, 13 to 15 is a bit rare, but 5 to 10 is very often. So you can see from here, you can roughly say you already reduce the volatility 10 times. Okay. Give you an example. Real life example. If you have a fund of 20,000 and your risk is 5%, that means you can afford to lose 1,000. You can afford to lose 1,000. If you do a outright, and for this candle, it is a range, it's a 160 range. It's a 160 point range, and it will cost you. It will make your account suffer 4,000 loss, and this 4,000 is exceed your risk level of 1,000. That means this one you will be kicked out from this game already. Okay. Whereas if you use the spread, the difference is 20 points. The drop is only 20 points for this extreme day. For this extreme day, 20 points. And on the paper, on your portfolio loss, not portfolio, your position loss, only 500. 500 is within your 1,000 risk, 5% risk. That means you're still in the game. You're still in the game to ride the trend up. Okay. So this is how we can use the spread to adjust the volatility to our advantage. You can use different kind of spread to adjust a different level of volatility. But they want how to adjust. We can talk later. But today we are going to do the calendar spread. Based on these figures, basically you can reduce 10 times the volatility. Okay. Okay. Then we talk about the this chart. We see there are times most of the time the spread and the outright move in the same direction. Move in the same direction. If let's say you see the spread go up and you see the outright go up, the spread normally go up. And you see the spread going down, normally you see the spread going down. So sometimes there are people that they read the outright chart, they trade the FCPO. Okay. Okay. In here also same thing. So it's same direction. But there are also times it's different direction. This one go up, this one go down. Okay. So if you use the outright chart to trade spread, sometimes you will say, okay, why outright is going up, but the spread going down? Okay, this situation happen very often. So your trading strategy must prepare for this condition, for this situation. Okay. Okay. What you should do? What you should do for in this case? You should maintain your stop loss. You should maintain your risk management. If it's going too far from your what you can risk, I think the easiest way is to get out first. Okay. We have to protect our fund. That's the ultimate most important thing to do. We have to protect our fund. Okay. So in this chart, I think a lot of people already seen this chart before. So in this pie chart, you can see the psychology for for a winning trade, the psychology is 50%, contributes 50% to a winning trade. And then the money management, which is the risk management, contribute to 30%. And a trading system, only contribute to 20%. So meaning that to win this, to win in the trading game, I call it a game, we first we must be able to execute our plan, our trading plan. Then you must position that our trade within the risk level that we can take. And this risk level must not be triggered by the volatility of the instrument that you trade. Let's say, for example, your instrument, let's say the spread, give you, it might go down 20 points. The volatility is 20 points. So if your risk is 30 points, that means your risk can accommodate this volatility. So unless the volatility go extreme, you will still in the game. Okay. So this is how I produce a consistent result by managing the risk and execute my training plan. Okay. So in here, you can see my slide here. Win and lose, I cannot control. That is what the market gives us. But what I can control is my emotion, which is the trading psychology, and the money management, which is the risk management. If I do this here, but if I can do it perfectly, based on this pie chart, I can get 80% winning. And if let's say, for example, nobody can, let's say, for example, nobody can guess a win and a lose better than just tossing a coin, which is 50-50, 50% by 50%. If I can get half of this 10%, I already get 90% winning probability already. So of course, not everyone can get a perfect each of this category, but you can see which factor contribute to the most to your winning trade, which is trading psychology and the risk management. Okay. So as long as you control your risk, execute your plan, I think you are on a good hand to earn something from the market. Okay. Okay. Another point which helped me a lot is the trend. We must follow the trend, trade along with the trend. Reason why you look at this one chart. When you are in a trend, that means it, let's say for example, move up, meaning that moving up is more than moving down. Moving up is more than moving down. So if I buy, the chances of me to get more profit is on my side. If I sell here, the chances to get more profit, I think is low because it's on trend. The retrace is always shorter than the impulse move That means the upward move Okay. If from here you still can survive. If you do it in here, let's say like that, and then you sell, and then it shoot up in this middle wave, then you can balik kampung already. So no need to trade game over. Okay. So must follow the trend. When we trade, must follow the trend. Okay. Okay. And then the next question is, we want to ride the trend without being checked out. So how do we do that? It's by you adjusting the volatility using spread. Okay, you're adjusting the volatility using spread. If let's say, for example, this one daily range of 130 point outright, you cannot take it. This one I think is around 4,000, right? It's not mistaken. Okay, you cannot take it. Your account cannot take it. So you can use spread, and use spread it reduce around times maybe 13. So 13 you can take it. Let's see, 13 is how much? 13 is only 325. So you can take the loss. You can take the volatility. So if you put a stop loss of 500 SL or 500, then you can accommodate this volatility. So you will not be checked out. Okay. Right? Okay. So by staying in the game, we have a greater chance to ride the trend up to your target price. Maybe it's very high. And then with this three attribute here, winning psychology, the money management, and the trading system, we should be able to turn a gambling to a statistic game. Just now, when I do the calculation, it's all numbers we can calculate from. It's a maths formula. Okay. Then we can turn random actually to turn random to maths formula. Actually, market is not random. It's actually is a demand supply. The only thing is you must stay in the game to ride the trend. Then the next one is trading the risk and rewards. That means we will become a business decision when we want to do a trade. Let's say for example, you risk 13 points and you can get 60 points. So is it a good business? If you think it's a good business, then you can enter this trade. Okay. And with all this, you will turn yourself from a trader to become a manager. So everyone should turn themselves to a manager rather than a trader. A trader is a bit sometimes it's a bit hard to get a consistent result, and it will be very stressful as well. But when you turn into a mindset, a manager mindset, you actually is managing the risk and reward, whether this business can do or not. If it's lose, it's okay because I'm willing to lose. If win, then I win big, 60 points. Okay. Okay. So now this one initially I didn't put in one, but I put it in to illustrate more clearly how I operate. Okay, a trade. Okay, let's say for example this is the spread chart, and this is today. And then a few days later, then we have one wave here. Okay, then we mark a middle line first, a middle line. Then we have another wave. The same thing is we mark the middle line. So this one to me is like a sideways. So I can draw a line, a mean line. Then I can divide the zone into 4 parts. 1, 2, 3, 4. Okay. And the one will be my sell zone, and this one will be my buy zone. Okay. So in this case, I already have the mean line, and I already have the zone divided. Then this will, at this moment, it will be my buy point. Then I will initiate a buy. Okay. Then this line is the stop loss. Stop loss, normally you can roughly, it based on your preference, either 50% of standard deviation or 100%. But this standard deviation we will talk about later. You just treat it as the price will be slightly lower than your buying price. Okay. Later on we will touch on the standard deviation. Okay. Then it go up and it hit my sell zone. I will close my position, close my buy position, and do a short. Okay. Of course, I will put a stop loss here as well. We'll put a stop loss here as well. Then it come down. Then in here, I will close my short. I close my short. I take profit, take 1 time profit, 2 time profit, and initiate buy here. Okay. Then it move up. Then of course it hit my sell zone. Then I close my buy and I initiate a short. But in this case, it hit my I follow the rules like what I have mentioned, the trading psychology. You must follow what you plan. And it hit my stop loss, then I get out. I get out. Okay. Then after that, then it shoot up. Luckily, I get out. Okay. Then I mark another point here because here you got one retrace here. This is the mean line. Then you draw one line here. Draw the mean line. Then you do the same thing. You divide the area into 4 sections. 1, 2, 3, 4, and 1 is the sell section, and 4 is the buy section. Okay. Then in here, so you see a sell signal here. Then you sell, and then you put your stop loss there. Then the middle line also is here, so it's on track. This mean line is not moving anyway. It's still intact. Then you buy here. Okay, you buy, you close the sell, and you initiate new buy, and you repeat this process. You repeat the process until you get enough of the profit. Okay. Okay. Next. Okay. So right now we go into FCPO and FEPO. We go into intercommodity sections. Before that, I just want to highlight a few points. Just now Susan already highlight the difference of FCPO and FEPO. Right now, I will highlight from the trader point of view what is important to us. The important to us is the trading hour. This one start at if not mistaken, it's 9:30. I'm not sure in 9 o'clock or 9:30 around that one. Okay. So and then the next one is the delivery point. Okay. So with in the past we only have these 3 port. With East Malaysia, when they want to sell using the Bursa product FCPO, they have to transport into one of the port to deliver the goods. But right now, with FEPO, we have delivery point in East Malaysia, so East Malaysia people can deliver to this point. Okay, this will bring the port near to the planter and the miller, and then as well as it will reduce the transport fees. And then also FEPO also give an option for foreign people to buy our FCPO. They can choose which delivery point. If going to China, theoretically it's shorter to get the delivery from the East Malaysia than the West Malaysia. But on the other hand, if you talk about India, which is one of our largest buyer, they will prefer the West Malaysia one. Okay, so the foreign buyer can choose. Now we give more options. In the past, we only have West Malaysia. Okay. Okay. So FEPO and FCPO, to me, what does it mean? To me, it means it's just another instrument or tools for us to profit from the volatility. So you look at this picture, this FCPO, the painting is FCPO, and the embroidery is FEPO. Both of these two, you can say is an art piece. It's art piece. So we buy and sell. It's same thing. They are commodity that allow us to buy and sell and gain from the volatility. That simple only. Okay. From trader point of view. Okay. Okay. What is intercommodity spread? Intercommodity spread is buying a related commodity and selling another related commodity at a given time. Okay, why I use given time? Because you can do it at the same time right now, buy and sell at the same time, or you can buy one leg first, then you sell another leg later. Okay, but at the end, the effect is still intercommodity spread. But if you don't do it at the same time, there is a risk of you lose more money lah. Of course, when you have risk, you have reward as well. Okay, it's up to you. You want to buy it at the same time, or you buy it at the different time. You build the spread at a different time. Okay, it's up to you. Okay, in theory, they should move in tandem lah, because these two products is related. They should move in tandem. Like for example, FCPO and FEPO. Basically, their delivery, the CPO crude oil is the same. It's the same. So they are related. So in theory, when these two are related, they should move in tandem. They should move in tandem. There are times that they move out of sync. Like for example, it go up, but this one take a deep foot before go up. Okay, this is our opportunity. This is where we can gain profit from the price inefficiency when the price is out of sync. Okay, so it's the same thing for calendar spread as well. This one happened in the intercommodity spread. Okay, so intercommodity spread you can use FCPO for the first leg using the same calendar month and sell the FEPO contract. Okay, this is the spread. Then the next one you can do is the spread of the spread. February March FCPO spread together with February March of FEPO spread. Okay. So in the coming example, I'm going to use the spread of spread for my example. So the same concept apply. The same calendar spread concept apply is we are trading the change of net difference between the two contract or spread. Okay, same principle apply. Okay, this is about 2 weeks data of FEPO. I think I typed wrongly at the FCPO. FCPO February, March. This one FEPO February, March. Okay. So to get the similar calculation, like just now I doing it in a visually, in a chart form, we can use Excel to calculate the difference. Then we can use a simple statistic formula, which you guys should learn it in the secondary school, to find out our buy and sell zone. Okay, this is standard deviation. So you don't need to figure out how to calculate. You just use the Excel formula to do it. Okay, STDVE. It's not mistaken. Okay, you use that formula to help you to calculate. Okay, so after calculate, you get these numbers. With this number, you can calculate the buy and sell zone. Okay, how to do it? Average is our average. This is our mean line. Standard deviation is normally the price will move in this area. So in this area, we plus and minus 5 from the mean line. Then we calculated the usual activity zone for this spread. Okay. Then you can buy below here up to the mean. This is mean. Or you can sell from this area up to the max. So with this one, you already get a buy sell zone and a no trade zone. Right. As well as this is a no trade zone. Okay. How do you take profit? It's up to you. It's individual preference. Either from here go to the mean line, you take profit, or from here you go to the mean line and take profit. Or if you are very confident, you can go up to the sell zone, then you take profit. Or from the sell zone, you go down to the buy zone and you take profit. Okay. Then the next one is stop loss. Okay. Stop loss is we have this standard deviation already. So you can use half of this standard deviation, which is roughly 3. We round up. So this one minus 3 become -1. Spread can go to minus. Spread can go to -1. Okay. Then your stop loss for this one is if +3, then equal to 22. If exceed 22, then you cut loss. Or you can use 100% standard deviation. Either you use 100% or 50% for easy calculation. Okay. So with this, you can get buy, sell, target profit, and stop loss. You already have your trading plan already. Okay. Next, you look at this chart. Actually, it's all go up, also go up. If we without the calculation just now, these two charts very hard to comprehend. Make sense. Doesn't make sense. In other cases, very hard to get a trading plan from this chart. But if we have done the calculation just now, we already have the trading plan already. So with the trading plan, we can do a pending sell order on the FEPO for bullish setup. Once once the FEPO sell order is matched, then you go to the FEPO and make the buy order. Then one buy, one sell, then you have a spread already. Okay, so in our case, I will recommend to use the FEPO spread and the FCPO spread instead of the outright. The same thing apply if you want to short sell the intercommodity spread. You put a buy order in the FEPO spread. Once the FEPO spread is done, then you make a short in FCPO spread. Okay. When you want to close your position, you do the reverse. The process do the reverse. Okay. And for this strategy, better is doing it on the active month, which is the third month of the FCPO. So for a start, I think we should play safe You better close your position 1 or 2 weeks before the before the 15th of the active month. Before 15th of the active month. Okay, that means you have 2 weeks to play 2 to 3 weeks Okay. Then from this chart from these numbers you can see normally it's around 2 weeks. Around 2 weeks you can get an exit and buying and exit. From this data might change depend on market. But from this data, you roughly the turnaround time is about 2 weeks. Okay, this one is a graphic form but I'm not going to touch on this one. Okay, so we do a walkthrough of how we place the order, like what I have just now have said. Okay, I go through the checklist first. Okay, look for the third month first. The current third month is G, is February. Okay, is G, G H. Okay, February, March. If we want to do spread, for start, I think better to spread. Spread of spread. Okay, better to spread of spread. Okay, safer. Okay. Then calculate the buy sell zone, like just now I show you in the Excel. Okay, buy, sell, profit, stop loss. Okay, to come up with your trading plan. Then more window. Okay, assume the buy zone is 6 to 2, which is the number just now we get. The sell zone is 16 to 19, the same number just now what we get. Okay, then place a FEPO spread order at the buy FEPO at the okay. Place either you want to buy or sell you place the order in either side. Either if you buy, you place on the buy side. If you want to sell, you place on the sell side. When the FEPO FCPO moves you adjust your FEPO order because we want to maintain this range. We want to maintain this range. Once the FCPO move, then you move the FEPO order. Okay, to maintain the gap. Let's say, for example, I want a gap of 16. So if it go up, then my FEPO, I will move up my order. If go up 1 point, I move up 1 point. Okay, maintain the gap. Okay, then if we want to if the FEPO buy order is done, let's if the FEPO buy order is done, then you immediately do the sell order in the FCPO. Then you will get the short spread, which is the bear spread. If you want to do a buy, you place an order in the FEPO at the sell order. Then once it's done, then you play the buy order immediately in the FCPO order. FCPO, you get the FCPO, buy it, and then you will get a full spread. Okay, then you will get an inter-commodity spread. Okay, you do the reverse to close it lah. Okay. To close it, I also in here I illustrate the opposite process. Basically, you do the opposite. You close the positions. Okay. Then we go to the illustration part. So right now we want to do a bear spread. Right now we want to do a bear spread. So we place a short here in the FEPO. This is FEPO. This is FCPO ladder, price ladder. This is their price. So we place a short order in the FEPO. And then we do a buy. We put two order. We don't know which one we will get hit. So we don't know which side we will get. So we put two orders here. If this order, this is buy order. So buy order, you look at here, when you see buy order in the FEPO, it is doing a bear spread. When doing a bear spread, what you need to do is you immediately go to the FCPO, go to sell one FCPO. Then you will get inter-commodity spread. Then after that, because you already buy already, you cancel this contract, cancel this order. Now you want to work on getting out because you already have entry already. You need to get out. Okay. So get out. This is the contract you have. This is the contract you have. Okay. So you place an order here in the FEPO is a sell order. You do the sell order. Then if it get hit, then immediately you go to the FCPO and buy the FCPO. Then this one is sell, this one is buy. You got match. It's clear. It's zero position, zero open position. This one is buy, this one is sell. Then you also got zero position. But with this one, you gain from here to here is your profit. Okay, this one because they trade at the same price, zero profit. So net you will get this much, this profit. Okay. Okay, this is the calculation. You sell 192 FCPO spread minus 173 FEPO spread, then you get 19. So your sell position is 19. Then you close the position at 2. Buy low, sell high. Then you get 17 point profit. Okay. So in a graphic format, is from 19, which is here, the expansion to narrowing. Okay, so a short will get you profit. So this is a short position. To get you profit, get you how much? Is 17 point. Okay. So we are trader. We don't take delivery. So you must get out at least 1 to 2 weeks before the 15th of the active month. Okay, this is very important. Okay, this will be my last slide. Okay, in spread remember just now the picture, the Kathmandu picture, we have a lot of wire here. Only the technician will know which leg and which leg is combined to become a spread. So in here, you can combine the FCPO, February and March spread, or to become a calendar spread, or you can combine the February, March, and March, April contract. Combine these two contracts and become a butterfly spread. Okay, so you also can combine February and March, April and May contract to become a condor spread. So these are additional variant of the spread, but in today we are not going to touch about. I just let you know there are different type of spread. Okay, you also can combine FCPO with FEPO to become a intercommodity spread. Okay, so you can explore this area in the future. But in this talk, we focus on calendar spread, which is February, March, and intercommodity. We buy one FCPO and then sell one FEPO on for the same active month. Then we can create a intercommodity spread. I think that's all I have.
Thanks a lot for Calvin, your presentation. Now, although it's quite late, but please bear with us. We are going to answer some of the questions asked by the audience. Now, first of all, if you have any question, right, you can type in the Q&A box. Remember, please type in the Q&A box, not the chat box, and please send it to all co-hosts. Now, as promised, we are going to have this lucky draw session, which we are going to announce in a week time. Now, you need to do two things to become the winner. Now, first of all, we are going to give out 5 Touch and Go e-wallet reload pin, each worth Ringgit Malaysian 100, and 1 prize for this book by Calvin, Profiting from Any Market. Now, how to be a winner? First, you need to answer all the quiz questions provided and prepared by our speaker. Now, later we'll provide you with the password. Second, you need to fill out and complete the survey form. Now, you can finish this all before 10:30 tonight for the cutoff time, and the results will be announced in 1 week, within 1 week, once Bursa Malaysia Derivatives selected the winner. Now, how can you participate in this particular lucky draw? You can scan this QR code, or else you can type excellent.com/FEPO. And in the chat box, we also provided you with the link. So right now, we are going to give you 2 minutes. Can you please just complete the 3 quiz questions and also to complete the survey form? Once you're very completed, you can type in the Q&A box and we are going to answer your question in a short while. So I'm going to give you 2 minutes. The link is in the chat box, or else you can scan this QR code. I believe the question is quite simple. If you all pay attention during just now the presentation by Susan Lau and also Calvin, then you should be able to answer all the questions. So please complete both quiz and the survey form, and we are going to continue to answer some of the questions before we wrap up the session. Okay, last 1 minute. Okay, for those who not yet finished, you can continue to finish the quiz and also the survey form. We are going to open until 10:30, so you can take your time. So right now, we are going to proceed to answer some of the questions being raised along the session itself. Now, the first question, maybe this question, Susan, maybe you can help to answer. FEPO will trade at night later.
Thank you, Ting Ting. Yeah, for the question, is it asking whether FEPO will have night trading in the
Yes.
future? Okay, yes. Currently, BMD is working towards launching the T+1 trading, means the after hours trading. Also, in simple terms, it's night trading. So yes, it will be FEPO is one of the products that is offering this feature.
Okay. Now, the second question, I think, is also referring to your presentation slides. So the question is, FEPO has enough volume to do spread?
Okay, so in terms of FEPO volume, right? Give me a second. Okay, so for in terms of let's talk about instead of volume, right? Let's talk about the bid and ask spread. So for FIFO calendar spreads, right? We're talking about calendar spreads. That means the bid ask spread, if you can check on the live trading platform, the bid ask spread for calendar spreads are actually very, very competitive, which is offers good, I mean, a good spread for trading. So meaning you can trade, you can do an entry and exit in the market with a good bid and ask. So no problem on trading calendar spreads for people.
Okay, I think the next question is also more towards your side. The question is, any platform allow us to trade spread in single entry? That's the first part of the question. Second part is, or we have to enter buy and sell separately like outright trading.
Okay, for platforms that allow, I think a lot of platforms are currently allowing us to trade spread calendars, especially calendars. Actually, most of the futures trading platform allows us to trade calendar spreads, and also whether it is trading the spreads by entering a buy and sell separately, like outright trading, depends whether it is listed. I mean, the spread is listed on the exchange. Okay, example, right? For FCPO calendar spreads and FEPO calendar spreads, yes, we do offer the spread listed on the trading platform. So yes, you do not need to enter it separately. You can just go to the spreads section and enter it in one single trade. So, but for those that are not included, like some of the intercommodity pairs like FCPO and FEPO, it is not yet being listed as a in a single line. So you may need to enter it separately as how Calvin explained it just now.
Okay, very good. Now the next question is, I think it's towards Calvin. The question is, what is the best time frame to do spread trading?
Okay. This is all depends on individual preference. I see many people are using 30-minute chart and daily chart to do it, but it's up to individual.
Okay. The next question is spread trading using the same technical analysis as we trade in outright?
Okay, I answer. Okay.
Yep.
So you can apply the similar technical analysis to spread. It's basically a spread chart is just like a normal price chart. You can apply the normal technical analysis to the skill normal technical analysis skill to the same chart. You can use MA indicator, or you can use the wave, elite wave, and whatever method that you use to. So you can apply the same thing, but you just need to tailor a bit on the volatility side. Maybe you want to tune your MA to suit the spread chart that you want to trade. Okay, just the parameter need to tweak a bit, but the same technique can apply.
Okay, Calvin, this is the question for you as well. Just now you highlighted that FCPO and FEPO will move in tandem in theory. So his question is, can you give example when it doesn't move in tandem?
Example, okay. My chart is still showing, right?
Sorry?
My presentation is still on the screen, right?
No. You want to share your presentation, is it?
Yeah.
You can share it. You can just grab it and you can just share it.
Now I skipped the chart because it might confuse a lot of people. So in here, you can see here, this one. Okay. Let me get the pointer out. Okay, you can see this one. So this blue line, FCPO. This is the FCPO mean line. This is the high, the max, and the mean. And this orange one is the FEPO. Okay, and the max is happen to be something similar On the lower part is the low This one is the low This one is the max. Okay, this line. So you can see this line you have a very drastic drop but here you don't have. So this is out of sync. And then this one you go up, come down, go up, come down. But in FCPO it's not going up. In fact it slightly go down. So this is also another example of it's go out of sync. Okay. So I hope I answer the questions. It does happen.
Let us take the last question, then we are going to wrap up for the session because it's because of the time limitation. Now, the last question is for Calvin. Can we do calendar spread between and among FCPO and FEPO?
Among is mean among calendar spread among FEPO and FCPO. Okay. I trying to understand your questions, but I just give you a few scenario so that maybe one of the scenario will cover you. Okay, so currency spread between FCPO and FEPO meaning that you can buy, let's say for example, buy FCPO and sell FEPO. You can buy at the same month, let's say February month, FEPO, and the February month of FEPO, FCPO and FEPO, or you can buy FCPO February and you can buy March FEPO also can. It's up to you. But for I think at this moment, I think it's better stick to buying the February March spread, FCPO spread, and selling the FEPO February and March, or you can do the other way direction lah. For a start is better lah. But the combination like just now what I said at the last slide you can make your own combination. You can mix with February and June, July, August, whichever you want to mix also can. It's up to you. Okay, you can do that.
Okay, thank you very much. So we are going to wrap up for today's session. Now, before we end, just to remind you all, upcoming, we still have a few sessions. For this particular month, next Monday, we have a topic on trade to win in FCPO and FEPO. We have a very, very experienced traders. He's going to share with us for this particular topic. And we are going to follow by 24th of November, how to diversify your portfolio with commodity futures. So if you would like to attend, please register via this QR code. You can scan this QR code, or else in the chat box, there's the link in the chat box as well. Now, just for information, beside this FEPO webinar series, we also have normal LF webinar series. It's also sponsored by Bursa Malaysia and brought to you by Bursa Malaysia itself. You can select the session and you can attend accordingly. It will be the same link. Now, for those beginners, if you would like to understand more about futures itself, and previously you already attended some session and you do not understand about the basic of futures, we have this upcoming online workshop, which is the last session for this particular year. So in this particular online workshop, we are going to cover from A to Z until you can start your first contract in futures trading. So this will be the last session. This weekend, we are going to have one session as well, but that particular session already full. So if you are serious in getting started in futures trading, please scan this QR code and register as soon as possible. We only open up to 150 participants, and on the day itself, only first 50 online attendees will be admitted. So please remember to scan and register accordingly. So this comes to the end of our session, and don't forget to submit your quiz and survey form to stand a chance to win these 6 prizes. Now, I'm going to wrap our session, and thanks to both our speaker, Mr. Calvin Chin, and also Miss Susan Lau. And thanks for your participation. We are going to see you in our next session. Bye-bye.
Okay, thank you very much.
Thank you, everyone. Thank you, Ting Ting. Bye-bye.